Welcome back. In this video, we're diving deeper into advanced Forex-specific risk management techniques. These strategies can help you navigate the complexities of the Forex market with precision and confidence. Let's break down how to manage the unique risks that come with trading different currency pairs. Managing currency-specific risk. Effective risk management in Forex trading begins with understanding the specific risk tied to the currencies you're trading. It's essential to stay ahead of market dynamics by closely monitoring macroeconomic indicators and geopolitical events that influence currency pairs. Take, for example, the Mexican peso, which is highly sensitive to fluctuations in global commodity prices, particularly oil. A sudden drop in oil prices can lead to substantial moves in USD MXN due to Mexico's reliance on oil exports. To mitigate this risk, stay informed on commodity trends and use economic calendars to anticipate price movements linked to trade balance and inflation data. This proactive approach allows you to adjust your positions in response to anticipated market shifts, effectively managing volatility. Historical data for market predictions. Analyzing historical data is a powerful tool for understanding how currency pairs have reacted to past economic events, central bank interventions, or significant geopolitical developments. By identifying patterns and correlations, you can enhance your predictive capabilities, giving you a strategic edge in forecasting future price movements. For example, understanding how a currency pair typically reacts to an interest rate hike can help you position yourself advantageously before the event occurs. Dynamic stop loss strategies. Risk management in Forex isn't just about where you place your stop loss, it's about tailoring your stop loss and take profit levels to the specific characteristics of the currency pair you're trading. For high volatility pairs like GBP JPY, using a fixed stop loss can lead to premature exits due to frequent price spikes and pullbacks. Instead, consider incorporating the average true range indicator to set more dynamic stop loss levels. The ATR measures market volatility, helping you place your stop loss at a distance that accommodates normal price fluctuations without getting stopped out too early. To further refine your strategy, combine ATR with Fibonacci retracement levels to identify confluence points that can serve as both entry and exit targets. This approach reduces the likelihood of adverse moves wiping out your trade. Here are some different kinds of strategies you can use to set your stop loss as per market conditions. Time-based stop losses. Instead of setting your stop loss purely based on price levels, consider time as a factor. For instance, if a trade hasn't moved in your favor within a specific time frame, you may exit the position regardless of the price. This helps you avoid holding on to losing trades for too long and ties up your capital in non-performing positions. Trailing stop loss. Trailing stops are a powerful tool for locking in profits while allowing your trades to run. Unlike a standard stop loss, a trailing stop moves with the price, maintaining a set distance from the current market price. In a trending market, this ensures you capture maximum gains without the risk of getting stopped out too early. You can set your trailing stop at a distance that accommodates the pair's volatility, ensuring it's not too tight to get triggered by normal market fluctuations. Position sizing and capital allocation. Effective risk management isn't just about where you place your stop loss, it's also about how much capital you allocate to each trade. Position sizing based on volatility is an advanced technique that tailors your trade size to the risk associated with the currency pair. To calculate your position size, consider the pair's volatility using the ATR. For example, if you typically risk 1% of your account on a trade, adjust your position size so that a stop loss placed 1 ATR away from your entry point represents that 1% risk. This method aims to keep your risk consistent across trades, regardless of the pair's volatility. Time frame and session diversification. Diversifying your trades across different time frames and sessions is another way to manage risk effectively. Forex markets operate 24 hours a day, and different sessions, Asian, European, US, have distinct characteristics. The European session, for instance, often sees higher volatility in euro pairs, while the Asian session may be calmer. By diversifying your trades across these sessions, you can capitalize on the unique opportunities each offers while spreading your risk. For instance, you might engage in short-term scalping during the high volatility European session and hold longer-term positions through the Asian session when the market is quieter. Hedging with options. For traders looking to hedge with precision, Forex options provide an additional layer of risk management. Options allow you to protect against adverse price movements while maintaining the potential for profit. For example, if you're long on Euro USD and concerned about downside risk, purchasing a vanilla put option allows you to lock in a minimum selling price. This ensures that you can exit trade at a predetermined level, even if the market moves against you. This strategy is particularly useful in uncertain market conditions where volatility is expected, but the direction is unclear. Stress testing and portfolio level risk management. An advanced approach to risk management involves stress testing your portfolio under various market scenarios to ensure resilience. By simulating potential crises or extreme volatility, you can assess how your trades might react and adjust your strategy accordingly. This method prepares you for black swan events, those rare but catastrophic market movements, ensuring you're never caught off guard. Managing risk at the portfolio level rather than just on individual trades is another sophisticated strategy. By analyzing the aggregate risk across your entire portfolio, you can ensure that you're not overexposed to any single currency or region. Diversification across currencies, timeframes, and trading strategies can mitigate systemic risk and contribute to a more balanced and resilient portfolio. Mastering these Forex specific risk management techniques requires discipline, knowledge, and a willingness to adapt. Whether it's using cross hedging strategies, optimizing your stop losses, or managing portfolio risk, these tools will give you the edge to succeed in the dynamic Forex markets. Stay ahead of the curve, manage your risk wisely, and watch your trading results improve. Happy trading!